Are you torn between selling and refinancing? Maybe I can shed some light on the subject. So, millions of Americans are facing financial hardship as a result of the COVID-19 pandemic. With so many losing income, many turn to refinancing in order to lower monthly payments or to cash out equity to cover expenses. While there are some benefits to refinancing with interest rates so low, it's important to look at the big picture before making such an important financial decision. Chances are there's an upcoming market correction. Many homeowners that refinance could find themselves underwater. On the other hand, homeowners that opt to sell their home while prices are high could find themselves in a really good position to purchase when housing prices decline. You know, sell high, buy low. With record low interest rates, 2020 saw the largest financial boom in history. According to a nationwide survey conducted by Bankrate, 17% of mortgage borrowers refinanced last year. That's huge. And of those surveyed that did not refinance, 16% could not qualify due to low credit score or unemployment, and 23% could not afford the closing costs. Sadly, many homeowners that opted for refinancing may face negative consequences in the future when the market drops. Now, do you fully understand refinancing? It's like this. A cash-out refinance will issue you a new loan to pay off your current mortgage and allow you to cash out a portion of your equity. Equity is the difference between your current market value and your mortgage balance. When you refinance, your new loan will carry a new interest rate and a loan term. Lenders require that you retain a certain percentage of equity, usually 10 to 20%. It's important to note that you may have to pay private mortgage insurance if you do not retain at least 20% equity. Private mortgage insurance protects the lender in the event that you default on your loan, and the premiums will be included in your monthly mortgage payment. Also, you will not pay taxes on the money you cash out because it's considered a loan, but you will need to pay a new closing cost. Another option is to take out a home equity line of credit against your home, known as HELOC. This route usually involves taking out a second mortgage. You'll be issued a line of credit that you can withdraw from during your draw period, which is typically 10 years. Once your draw period ends, you will start repaying over a 20-year period. While cash-out financing offers a fixed adjustable interest rate, HELOC interest rate will vary according to an index, usually the US prime rate. While refinancing can be tempting during a time of financial and economic uncertainty, you'll want to consider the long-term consequences. According to the Mortgage Bankers Association, 7.65% of mortgages on 1 to 4 unit properties were delinquent at the end of the third quarter in 2020. This number is substantially higher in some areas of the country. Florida's delinquency rate was at 15.15% due to the market's heavy dependency on tourism and leisure industry. And home values have continued to climb because housing inventory remained low, driving competitive bidding. However, the moratorium on foreclosures is set to expire on June 30th. Once the banks foreclose on delinquent mortgages, inventory will increase, which will very likely result in a drop in consumer confidence and declining home prices. If you refinance, you could find yourself upside down on your loan when home values decline. It took 10 years in many areas of housing prices to recover from the 2008 recession. So if you do not plan on staying through another cycle, consider this. If your property value drops substantially below what you owe, you may be forced to short sell your property. Then your credit could take a hit of over 160 points, and this would impact your credit for years to come. Refinancing only makes sense if your current interest rate and your mortgage is high, and you have enough equity to cash out and still retain substantial equity in your home. Plus, you have job security and you plan on staying in your home for at least 10 years. Of course, you'll also need cash on hand for closing costs and decent credit to qualify. Selling your home while prices are high might be a better financial decision. According to Realtor.com, national housing inventory declined 39.2% and the average sale price increased 12.7% over the last year. The seller's market is so strong right now. Many sellers are receiving multiple offers, resulting in bidding wars on their homes. So, everyone wants to sell at the top of the market, right? But we don't usually know we've hit the top of the market until prices start to decline. 2020 provides a unique opportunity since we can now look at leading economic indicators and predict the top of the market with greater certainty. If you're in a position to sell at the top of the market and maybe rent or stay with family until prices decline, you could really come out ahead. For more information about selling, buying, and refinancing, head on over to relativity.com, your site for intelligent real estate.